Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and thank you for listening to the Grow Your Wealthy Mindset podcast. Today, we're going to talk about emergency funds. So what is an emergency fund? An emergency fund is money set aside to cover any financial surprises or sudden large expenses that life might throw your way. The biggest one is probably the loss of your job. The COVID pandemic showed physicians that our jobs are not as secure as we once thought they were. Many physicians were furloughed or forced to take their vacation days or sick days while clinics shut down during the pandemic. Other physicians were actually laid off from their jobs, and some worked without getting paid at all. Medical emergencies may also come up unexpectedly. Depending on your healthcare insurance coverage, you may suddenly find yourself with high medical bills if you're in an accident or suddenly need surgery. Unexpected home repairs can also be very expensive. You may have thought the roof still had at least 5 to 10 more years left on it based on the inspection report you got when you bought your house, only to find multiple leaks with the first big rainstorm prompting a new roof much sooner than you expected. This actually happened to me when I purchased a short-term rental. On the next house, I got a roofer to take a look to get a better idea of the age of the roof. You learn from your mistakes. While car repairs may not be as expensive as a new roof, they can still be quite pricey. This year, my husband's Honda CR-V started making sounds when it was driving. It turned out to be the propeller shaft, and it was over $3,000 to fix. We couldn't even use our 10% coupon on the service, I think because most of the cost was the part itself. From what I'm told, the propeller shaft is not something that breaks often, but it can happen at any time. And unfortunately for us, it happened within a year of the car being out of warranty. While it wasn't fun to pay for, having the cash on hand for a $17,000 roof and a slightly over $3,000 car repair made for much less stress than if we didn't have that money readily available. These two incidents happened about 2 months apart from each other this year. My mother consoled me. If you've got a problem the money can solve and you have the money, it's not really that big of a problem. And I actually think about that whenever I do have a big sudden expense that, yes, I have the money for this, so it's not really a problem. And it really helps me continue on. Having an emergency fund can really decrease your stress when a life emergency comes up. It's a safety net. Knowing that you have a way to handle life's unexpected events without adding money worries to the list can really be a blessing. So having an emergency fund prevents you from having to borrow money when you're in a pinch or to sell investments like stocks at a loss. You don't have to start problem solving or making decisions when you already have something extra on your plate. I could spend my time calling roofers to get multiple quotes and not think about how to pay for it, whether I wanted to sell stocks or bonds or which account to do that in order to pay for the roof. Instead, I had the cash on hand and I knew I had the cash, so I could just concentrate on getting a new roof before my next set of guests came in. So how much should you have in an emergency fund? Traditional wisdom generally states 3 to 6 months of your basic living expenses. So this is going to include things like your housing, food, utilities, healthcare costs, transportation, your basic personal expenses, and the minimum amount on any of your debt payments. You don't actually have to save 3 to 6 months of your income, just of your bare necessities. You can temporarily decrease your spending on things like vacation, entertainment, or dining out at restaurants if you have to. Depending on your employment situation, you may want to consider having even more than 6 months. Some people like to even have a whole year, especially with a possible upcoming recession when the length of unemployment may be longer. People who don't have a steady income, like physicians who mostly do locums, may also want to have a larger cash cushion. As an employed physician, it can take much longer than 3 to 6 months between paychecks if you were to be let go. Typically, physician contracts will have a 60 or 90-day period where either party, the physician or the employer, can terminate the employment contract by choice without any fault on anyone's part. If you have a non-compete in your contract, this may still be in place if you were let go without cause. This may prevent you from getting a job nearby for the length of your non-compete, which could be 1 to 2 years. If you go to another state, it can take months to get your license, depending on what state. Credentialing with insurances, surgical centers, and hospitals can also take 60 to 90 days. And it can also be nice just to have some FU money, such that if things really go bad at work, you know you can leave and have enough money without your salary until you decide on what you want to do next. Where should emergency fund money be kept? Your emergency fund is not an investment, but if you can earn some interest on it, there's no reason not to. The point of the emergency fund is that it should be readily available when you need it. It's not a bad idea to keep some cash on hand, like actual cash at home. You probably don't need a lot of it, but a few hundred or even a few $1,000s certainly doesn't hurt. You generally want to keep your emergency fund somewhere where the money is liquid and easily available. Unfortunately, this means that it generally won't be earning much interest. Most people will keep their emergency fund in some sort of bank account, either a checking account, savings account, or money market account. What is best will somewhat depend on what you like to do with your banking and what options you have available to you. With a checking account, you can have pretty instant access to a debit card or checkbook. Many banks are also linked to Zelle, where you can send payments directly. Your checking account may be linked to PayPal, Cash App, or Venmo. The downside of a checking account is that it generally earns minimal, if any, interest. A savings account can earn more interest. Usually there's a limited number of withdrawals you can make from your savings account, so that's something to keep in mind. You also don't generally have a debit card or the ability to write checks from a savings account. But if your savings account is linked to your checking account, then the money is a quick transfer so long as your online banking system isn't shut down. The transfer may be immediate or may take a few days depending on your setup. There are some higher interest rate savings accounts that are typically online, like Capital One or Ally Bank, and those are good places to consider for your emergency fund as well. With Capital Bank, you could have a savings account as well as a checking account online, and then it's a quick transfer from the savings account to the checking account, and then you can access the money in the checking account through your debit card or checkbook. However, because the Capital One account is online, you can't necessarily go to a bank account branch and actually get cash. So then you would still need to have a checking account at a brick and mortar bank in order to be able to get cash on hand very easily. But again, the debit card does give you a way to get some cash, but maybe not thousands of dollars, because most debit machines have a limit on how much you can take out a day. Some money market accounts may have the advantage of allowing you to have a debit card and have checks so that you have access to your money as soon as you need it. Of course, if you really do need cash, you still need somewhere where you can get that cash. There may be a minimum balance to avoid fees on these type of accounts, either your checking, savings, or money market accounts, which is something that you may want to consider. There may be a minimum balance to avoid fees with checking accounts, savings accounts, or money market accounts, depending on where your account is at. That is just something else you may want to consider. Depending on your spending habits, you may want a separate account from your emergency fund that is different than what you are using to save money for a down payment for a home or for your next vacation. Most people are better off having their emergency fund in a different account than the checking account where they use to pay their everyday bills. Keeping your emergency account somewhere a little bit out of sight will prevent you from spending it when it's not a true emergency. A vacation may sound like an emergency when you had a bad day at work, but that's not what you want to use your emergency fund for. You could consider using I-bonds as part of your emergency fund a year after you purchased the I-bond. An I-bond, or Series I savings bond, is currently paying 9.62% interest, which sounds a lot more attractive than whatever you're getting your savings account or what your money market is paying. I-bonds, which are indexed to inflation, are more like inflation-protected cash than bonds. The catch is that you can't redeem your I-bond in the first year after you bought it, but after the first year, it can serve to be part of your emergency fund. During years 1 through 5 after purchase, you give up 3 months of interest if you do redeem your I-bond, but after 5 years, you lose nothing. You could also consider putting some of your emergency funds into CDs or certificate of deposits. With a CD, there is an early withdrawal penalty, but if you need the money, it is available to you. You could also consider setting up a CD ladder so that some of that money becomes available regularly. If you don't need it when it becomes available, you would just buy another CD. To set up a CD ladder, you would put equal amounts of cash in different CDs with varying term lengths. I wouldn't advise putting all of your emergency funds into a CD ladder, but let's just say that you want to put $50,000 of your emergency fund into a CD ladder. You can spread out that $50,000 across 5 different CDs, each with terms ranging from 1 year to 5 years. So you would put $10,000 in a 1-year CD, $10,000 in a 2-year CD, $10,000 in a 3-year CD, $10,000 in a 4-year CD, and $10,000 in a 5-year CD. As the CD matures, you reinvest the money in a new 5-year CD. So after 5 years, you'll have 5 5-year CDs with one maturing each year. Then any year that it comes up, that money becomes available. If you don't need it, you just buy another 5-year CD. And this way, you do have that $10,000 coming up every year to be available should you need it without having any penalty from early withdrawal. Some people suggest using their HELOC or home equity line of credit as their emergency fund. While HELOC may be a good place to access funds when you're in a pinch, it's not the most reliable of emergency funds. One reason for having an emergency fund is to avoid taking out debt. If you're using your HELOC, you're using a line of credit, which means you're taking out debt. Most HELOCs do have a lower interest rate than other types of debt, but it is still more debt. Your HELOC can also be closed by your bank at any time. It's also more likely to happen at the time where you most need that emergency fund. When the COVID pandemic first hit, lending tightened, and there were HELOCs that were closed. It became really difficult to open a HELOC for some time. Lending tends to tighten when the economy is not doing well or when things are uncertain. Unfortunately, this is also the time when people are more likely to actually lose their jobs or need emergency funds. As they say, when it rains, it pours. You don't want to find yourself in a financial situation where you need money, interest rates for borrowing are going up and becoming more difficult to come by, it's harder to get a loan, and getting a new job is more difficult. So when is it okay to not have an emergency fund? Well, if you're paying off high interest debt, like credit card debt above 10%, or even anything above 8%, then you may not want to have an emergency fund because that debt is growing at such a fast rate. You have an emergency fund so that you don't have to put things on credit cards with high interest rates when you get in a pinch. But if you already have debt at high interest rates, your first priority is really to get those paid off. If you're in an emergency, then you're just going to put more onto your credit cards. In fact, having an emergency fund is to prevent you from having to take out high interest debt and getting into a problem with that debt. Unfortunately, you often need an emergency fund at that time of your life where it's actually hardest to save up for emergency fund and where the opportunity cost of having cash just set aside for an emergency fund is the highest. Early on in the physician career, having 3 to 6 months of emergency funds is probably not the top of your financial goals. You're working to pay down debt like your student loans, saving up for a down payment on your home, and trying to contribute to retirement accounts for your future. At this point, when an emergency comes up, it may mean taking out money earmarked for that down payment of your first home or contributing less to a retirement account, but that's okay. If you're really in a pinch, you could withdraw from your Roth IRA or other retirement accounts in order to get some money. You can withdraw your contributions at any time without penalty and taxes as long as you redeposit the fund within 60 days. However, if you miss that 60-day window, you'll have to pay an early withdrawal penalty as well as taxes. And maybe worse yet, you'll also miss that money growing tax-free and being available for you when you decide to retire. If you're financially independent, your emergency fund really just becomes part of the cash portion of your portfolio. And in fact, the wealthier you are, the less need you actually have to have an emergency fund because if you're wealthier, you have more assets and you can tap into those assets as needed whenever you have financial needs. Some people don't think an emergency fund is really necessary for doctors. They'll say things like there's a 30-day grace period on credit cards and each paycheck is fairly sizable and comes regularly. So if there's a pinch, you put on the credit card, you use your next paycheck to pay it off. They also cite things like tapping into your HELOC or worst case Scenario, just selling off your investments. The purpose of your emergency fund is to avoid going into debt or selling off investments when you're in a down market. Right now, we're looking at an upcoming recession, or some people say we're already in a recession. The stock market has been going down, and on top of that, interest rates are rising. So if you lose your job in a recession, a 30-day float on your credit card is really not going to help you that much. How much debt do you want to take out with increasing interest rates? And how much do you want to sell your investments and lock in your losses instead of allowing them time to recover? Your emergency fund can be an important part of your financial security. It's there to protect you from the unexpected. You don't need a complex system for your emergency fund, but you can try to set up what works for you. Thanks for listening to another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, please subscribe and let me know by leaving a review. It really helps get the word out. And now the disclaimer. I am not a certified financial professional, and this show is really just for your education as well as your entertainment. I'm also a physician, but I'm probably not your physician. So if you need any medical advice, please consult your own physician. Thank you.